Good afternoon, everyone. Greetings and salutations. My name is Tanjim Hussain, and I'm a professor of marketing here at Rotman and the Department of Management at UTM, where I also serve as the department chair. And I also serve as the director of our research center, Behavioral Economics in Action at Rotman. Today, it's my distinct pleasure to welcome Professor Martin Kocher, the governor of the Oesterreichische National Bank. Sorry, I thought I almost got it, but no. Which is the Central Bank of Austria. Prior to that, he served as the Federal Minister of Labor and Economy and the Federal Minister of Digital and Economic Affairs in the government of Austria. He's also a professor of economics at the University of Vienna and is a very well-published and well-cited experimental economist. His papers have been published in the AER Review of Economic Studies and Management Science and other journals. As an experimental economist, I have read and cited quite a few of his papers, which I found really innovative and insightful. And he has covered a wide variety of topics, including dishonest behavior, group versus individual decision-making, and institutional choice. I could talk about his work quite a bit more, but that's not what we are here for. Without further ado, I would like to invite Governor Martin Kocher to give his lecture entitled Monetary Policy and Behavioral Economics. I'm really looking forward to the talk. And Martin, welcome to University of Toronto. The floor is all yours.
Thanks. First of all, thanks so much for having me. Thanks, Tanjim, for organizing that. It's a great pleasure to be here. And I would try to talk a bit about two aspects where I actually know a bit, but not that much yet. So you see it's a bit work in progress, and I have a few examples. In the end, I want to convince you that behavioral economics is really helpful for macroeconomics and especially for monetary policy. And there's lots of different angles you could take, but I would, as I said, use a few examples to show you. And all this is, of course, work in progress and some work by others, some work by colleagues at the Austrian Central Bank, the Oesterreichische Nationalbank, which is a very difficult term to pronounce. And I'm very much looking forward to receive feedback and ideas on the topic. I guess most of you know what behavioral economics is. That's where I started out as an academic, and I make it very short at the beginning. You can have a very narrow definition, deviations in behavior of economic subjects from the standard assumptions that we use in economics. You could have a broader definition where heterogeneity in fundamental preferences regarding, for instance, uncertainty or time or other dimensions of preferences are already part of behavioral economics. Usually, it's not so important to have a clear definition. Importantly, we talk about behavioral economics when we have these deviations, and you'll see in the examples that the definition is not so relevant. Here's a few examples where behavioral economics matters in macroeconomics, and there's much more, but these are of course very important topics in macroeconomics, like savings decisions, and I mentioned a few biases or a few aspects that we are interested as behavioral economists when we talk about savings decisions, labor markets and relational contracts, of course, reciprocity and equity aversion, expectation formation, we'll come back to that, which is of course very important for monetary policy when we talk about inflation expectations especially, but not only inflation expectations, also expectations on the development of the economy and other expectations. Valuation, I'm not talking too much about that. Money illusion is one of the examples that matter a lot. When we talk about the effects of inflation over time, valuation matters, of course, so how people perceive prices, how people perceive their purchasing power, so that will matter. I will have a few examples there. I will talk a bit more about the communication of central banks, because communication, of course, matters for transmission of monetary policy. It matters for the speed of transmission. It matters for the way people perceive monetary policy, and it matters, of course, for businesses when it comes to credit and other aspects. And I would like to take the opportunity to talk a bit about trust and independence of central banks. This will be the first example because I think it's quite relevant at the moment, given political discussions, and it is very important to understand why we have independent central banks and why trust is a prerequisite for this independence, in my view. I don't talk too much about macroeconomics, but let me just say, if you talk about the use of behavioral economics, and I was very often asked as a behavioral economist, how can we use behavioral economics for policy applications? And in macroeconomics, sometimes that's pretty straightforward. You have a decision problem, it's well structured, and you can use behavioral economics to improve the explanation of behavior. And some people have called it, that's I think a quote by Werner Goethe, but I'm not sure whether he was the first to call it that way, a neoclassical repair shop. You have neoclassical economics, and what you do is actually you introduce more general preferences, or you introduce some biases in decision making or perception, and you can model that explicitly, and then you have a model that explains behavior in a better way than the standard model, which is not too complicated because you're adding, of course, additional complexity to the model. We have very good empirical support for that. What we are not so good at is, as behavioral economists, is predicting behavior on the individual level. What you want to do, of course, is, not necessarily, but what I would be able to do as a behavioral economist would be to have a set of characteristics, and based on the characteristics or preferences, I would like to be able to predict on the individual level how people behave. And that's quite difficult. I mean, we have some positive indication or some positive results when it comes to time preferences, I would say. It's much more difficult for non-standard uncertainty preferences or risk preferences. But still, I mean, there's much room for improvement here, actually. There's lots of applied concepts in policy making, nudging, debiasing of routines, incentive mechanisms that take into account other regarding preferences, and so on. So there are lots of applications here. When we go out and consult companies, we advise them how to implement an incentive mechanism, for instance, then behavioral economists can do a good job in making these incentive mechanisms better than incentive mechanisms that are based on standard preferences. And I think that's quite comforting to note. In macroeconomics, very briefly, this is much more complicated because this neoclassical repair shop paradigm is much harder to apply. Why? Because the models are more complex and there are more degrees of freedom regarding parameters, and that might lead to some arbitrariness or more complexity that they want to have. And you have a large set of possible, of course, aspects of heterogeneity and biases to choose from. Matter in macroeconomic models. It's the expectation formation, it's perception, it's perhaps the risk preferences, the time preference, and so on. So applying that is much more complicated. And of course, we know that this matters, but standard models could be, in their as-if nature, better than models that take explicitly some of these behavioral economics results into account. And I think the jury is out there still. I'll show you some examples where I think it makes sense, but you'll see later on, and I'm not sure whether we all agree on that, actually. There's little consensus on, as I would call it, canonical economic policy applications of behavioral economics in macroeconomics. And as I said, I want to come to some examples. So I hope that this short introduction is sufficient to give you a flavor of how I think about these examples more generally, actually. And the first is the role of trust for central bank independence. And I assume that most of you know the basics about central banking and the basics also for central bank independence. There is a lot of reasons that are mentioned, but let me just stress 3 reasons for central bank independence here. First of all, avoiding state financing. You don't want to have state financing for obvious reasons, because it might lead to high inflation later on, because the limits are not observed. Avoiding political business cycles in monetary policy. If there is central banks that are not independent, there is of course pressure that they increase the spending, they reduce the interest rates before elections. They would, of course, then lead to inflation later on. But this one of the basic ideas. You want to avoid this political business cycle in monetary policy decisions, and that's the reason why we have independent central banks. Note, and this will be important later on, that this requires the assumption that voters are myopic in a democracy. If they were not myopic in a democracy, you wouldn't need any independent central banks, because clearly the voters would take that into account, and a party that would spend too much or they would reduce interest rates at a time where it's not appropriate would be punished in elections, actually, and they wouldn't do it if they knew that they would be punished in elections, actually. Okay, so the government and the central bank would have more aligned objective functions if there was not myopic voters, actually. And this is just assuming, of course, a public choice model in a benevolent dictator model. The solution would be a bit different, actually. One of the things why central banks are independent is also the long-term perspective. That again requires some myopia by voters or by other decision makers in a democracy. But it includes, of course, implementing in the short term unpopular but necessary policies. I sometimes use the term agent of the long term. So if you're independent, you can be the agent of the long term as a central banker. As I said, trust, I think, is a prerequisite for central bank independence, because if politicians do not think that delegation of monetary policy to central banks is in the long run beneficial to them, it would be not sustainable, or perhaps not sustainable in a democracy. And just as a reminder, central bank independence is not something that we have been observing for hundreds and hundreds of years. It's a pretty recent phenomenon. So most central banks that are now independent, they gained this full independence in the 20th century, sometimes perhaps closer to the end of the 20th century. There is different, of course, layers of independence. We could go into detail what independence means. Independence does not mean that you can do what you want. There is some, of course, institutional frameworks. But it's a pretty recent phenomenon. If voters do not think that delegation of monetary policy to central banks is in the long run beneficial to them, it would not be sustainable in a democracy again. So you need both, of course, the politicians and the voters to have a certain understanding of independence as beneficial to them in the long run. So for that end, politicians and voters have to trust that central banks guarantee price stability in the medium term. If you don't trust that the central bank is able to actually reach their objectives in their price stability mandate, then of course there's no need to provide independence or to defend independence of central banks, actually. And then we come back to the question: how can you foster trust in such an environment? Because creating trust is, as I said, the prerequisite for the independence. So voters do not seem to care enough about the long term. Otherwise, we would not have political business cycles in public finances, and very often also unrealistic promises in election campaigns. So why do they care about the central bank independence, or put differently, why is central bank independence perhaps stable in democracies? And I think that's the key question here. And of course, there might be different answers to that question. And I try to convince you that one answer is perhaps a promising route for a nation. And I go back to a model that some of you might know by Drew Funberg and David Levine in 2006 in the ER, a dual self model that can explain the inconsistency between the short run self and the long run self. And the idea of the model, and I'm coming into more detail in a second, is that you have an understanding of your long run interest. This is an individual model, so we're not talking about institutions here, so you have to be careful in actually over-interpreting the analogy. But the basic idea is there is a long run self that understands rationally what is good for you. But in the short run, you're tempted. You're tempted to do something different. And their main example is, of course, whatever, working out or spending too much. So everybody knows that you know very well in the long run what's good for you in terms of health, in terms of whatever, working out. But in the short run, there's always a chance for deviating from this long run optimum, because immediate gratification gives you something different, or a different behavior would give you immediate gratification than actually investing into your workout and doing what is good for you in the long run, actually. So it's a commitment problem, actually, that you have. And I would want to argue that same commitment problem that democracies have when they talk about monetary policy. So as I said, the basic idea of the model, and again, I said it before, it's an individual model. There's a long-run self that is forward-looking, maximizing lifetime utility, and wants self-control. And a short-run self, it should be SR self, that is myopic, cares only about current period payoff, and tempted by immediate gratification. The long-run self can restrict the short-run self by choosing commitment devices or setting rules. By doing so may be costly. Obviously, it may be costly to have a commitment device. And the behavior results from the interaction, and it's a game theoretic model, between those two selves, actually. And the model delivers, first of all, a micro-foundation for quasi-hyperbolic discounting or beta-delta discounting, a formal way to analyze self-control, temptation, commitment, and predictions about when people stick to long-run plans versus succumbing to the temptation, actually. So this model is, as I said, a model of a split personality. And what we can do, I think, and I don't provide you the formal proof, is extend it to the collective action institutional problem we have. As already indicated, trust in the institution is a prerequisite. Otherwise, I would not use it as a commitment device. I would only use commitment devices that work if I know that central banks, or if I expect that central banks would not follow through with price stability mandates. I would not use it as a commitment device, actually. The interesting question here, and I'm looking forward to the discussion, is, of course, why does it work, if that's true, and if you accept that this is one of the reasons why we have independent central banks, why does it work for committing to the long-run positive outcome in monetary policy, but not in other policy areas? For instance, when we talk about climate policies, or even more directly, fiscal policies. And there might be some reasons why this is the case. So what is special about monetary policy? One reason, I think, is monetary policy is, for that matter, very easy to describe, and it consists of only a limited set of parameters. Interest rates and a few other instruments that monetary policy decision makers usually have. There are some less. There's of course this classical instruments. There are some special instruments that are sometimes used, but the classic instruments are pretty limited. There's a couple of parameters that you choose as a policymaker, and that usually is at the discretion of a central bank and the decision-making body in a central bank. Fiscal policy is much more complicated. There's of course lots of things to do. You have to set taxes, you set social benefits, and so on and so on. So it's much more complex. That's probably one of the explanations. It doesn't explain why, for instance, there is not a decision-making body that sets, for instance, rules on the maximum deficit. So that would be very equivalent to monetary policy. In monetary policy, you set the interest rates. You could have a body, an independent body, that says, look, we know we've analyzed the economic situation, the macroeconomic outlook, and the maximum deficit this year of whatever, the federal level or the provincial level should be whatever 2%, 1%, 1.5% of GDP actually. So you could actually have that, and then the government can of course decide about the composition of the policy choices completely independently. It's a good question. I have no answer to the question. So monetary policy is special to a certain extent, but you could of course relate fiscal policy in a similar way to monetary policy. And when we talk about, for instance, climate policy, the idea of the Paris protocol is of course a similar one. You have this reduction path. That is a commitment device. It's not a very good commitment device, unfortunately, but the basic idea is providing a commitment device to governments to stick to a long-run climate policy that is in the interest of everybody. And you can come up with other examples here, actually. So I probably skip that in the interest of time. So I think it's pretty straightforward that trust in institutions can be actually fostered by certain policies or certain activities like transparency, accountability, competence of the decision makers, and so on. It is also important that you not only decide in the interest of the public but also communicate well. And that's the next example I wanted to talk a bit about. So communication of monetary policy. Of research on that. Actually, to be honest, there's much more research on it than I thought so, and most of it has a gist of behavioral economics because the way you communicate matters for the perception of monetary policy. And there's a couple of examples here, how to communicate, for instance, uncertainty, who communicates to whom, so to what extent you tailor your communication as a central bank to the experts, financial market participants, the general public. Does that work? Can you actually tailor the information, the communication? Can you actually segment your communication? Which narratives might help in communicating monetary policy effectively? If you take a look at the monetary policy decisions and the communication, the ECB is always providing monetary policy statement of a couple of pages, usually 3, 4, 5 pages. There's lots of jargon in there, and it's very important that you use the same over some time to get people acquainted with it. If you change it, you have to know that changing only small parts of it will be interpreted as changing some of your policy stance or some of your assumptions behind that. So the narratives matter a lot here, or the specific wording, but also the way of how the decision is made. For instance, whether a decision was taken by unanimity or by a majority in the respective committee that takes the decision. There's a lot of, as I said, research and a lot of discussion. I'll talk a bit about the ECB now, but the Bank of Canada has, of course, similar elements of decision making. So one of the discussions we had at the ECB over the last couple of years was on forward guidance. Forward guidance is providing ex ante information on your reaction function, your monetary policy reaction function. And it was seen as a very valuable tool in low inflation environments, so from 2016, 17 to 2021. But it had very high costs, or potentially high costs, in changing circumstances, especially in 2022 when inflation surged, and forward guidance made it more difficult to change the monetary policy stance. There's some evidence for delayed liftoff of interest rates in 2022 because you want to, of course, maintain your credibility. That makes it difficult to change your communication quickly if you provided forward guidance. On the other hand, you know, of course, it creates some costs if you're not able to react quickly. Also, uncertainty matters a lot. How should central banks communicate uncertainty? There's lots of different ways. So there's a very nice overview by the Bank of International Settlements, the BIS, a very recent one in 2025, where they show what central banks around the world use in terms of communicating uncertainty about the outlook and the monetary policy stance. So there is fan charts, there's density forecasts, there's scenarios, there is the so-called dot plots in the US, where all the members provide a monetary policy preference, and so on. It is actually not the case that you could actually identify one of these ways of communicating uncertainty in your outlook. And there's two outlooks that are important for monetary policy, the growth outlook and the inflation outlook, that one of these ways of communicating the outlook is better than the other. So this is probably the reason why there's a huge heterogeneity in the usage across different central banks. The Euro system, the ECB, has been preferring scenarios sometimes. So there is no fan charts and dot plots and no density forecast usually. Sometimes this is provided, but not always, including a narrative and the policy responses. But whether this is better than others, we don't know. The key question is, or one of the key questions, and I'm coming now to a specific research question, is what moves financial markets and why? There is a you see that here a taxonomy in terms of the salience of the information and the informative relevance for future policy. And there's some examples in this matrix. If the salience is low and the informative relevance for future policy is low, we're talking about the technical working paper on forecasting method. Nobody would attach too much value to that in terms of predicting future policy, and usually it's not very salient to the public. The most salient and the most informative and relevant for future policy is, of course, the official monetary policy statement that is issued after each meeting. But there might be, of course, things that have high salience but low informative relevance. For instance, some policy leak, usually they are anonymous, and the decision-making in the Bank of Canada is pretty straightforward. There are not too many people involved. In the ECB, we're talking about 27 people that vote. Not all of them vote at the same time, but that's getting into more details now. And then, of course, people are involved in the projections outlook. So there's at least 40, 50 people that are knowing quite a lot about monetary policy in the euro area. So there is, of course, sometimes leaks out of this circle. And the interesting thing is, there is a study by Ehrman and co-authors that these leaks, and these leaks are published somewhere, Bloomberg, Reuters, the large networks, these leaks, they move the markets, so they move financial markets, not always, but they sometimes really move financial markets. But they are not informative about upcoming decisions. So it is irrational to a certain extent that the market is moved here. Because the market should not move if there is no information value. Obviously, markets move, and you can show that. And one explanation here is the man bites dog news. So there is an influence on the perception of the majority. And I have another possible explanation, a more standard one from behavioral economics, and that goes back to levels of reasoning in decision making based on non-equilibrium models. And you might all know the classical beauty contest example by John Maynard Keynes in his general theory in 1936, where it's about pictures, and you would have to determine the most beautiful one of different pictures, and you get a prize if you identify the person who is perceived as the most beautiful one by the majority. And he says it's not rational to choose, of course, the most beautiful one. You have to think about what other people think. So you choose the one you think that the majority finds most attractive. But if everybody thinks so, you choose the one that everybody thinks is the most attractive, and so on. So you have higher levels of reasoning, and there is a set of models in experimental in behavioral economics that have been also studied experimentally. Rotman Nagel was the first in 1995 that are called K-level reasoning models. And if you apply that to these leaks, then you have this chain of expectation formation that is typical for this K-level reasoning. So recipients might know that the leak is uninformative, but they think that others might find them informative or the leak informative. So then, of course, it makes sense to move on the leak. Or recipients know that the leak is uninformative, and they know that others know that it is uninformative, but the other think that other thinks that they might find them informative. So then the market moves on the basis of this higher levels of reasoning. Not sure whether this is true, but it's perhaps one of the reasons why we see these movements on leaks in monetary policy, usually shortly before meetings of the committees, the relevant committees or decision-making bodies, but why we see that they are not informative about upcoming decisions. So usually they are just white noise in the media. There is lots of other research on monetary policy communication when we talk about the general public, not so much the decision makers on financial markets, the experts in, for instance, investment banks. There is, of course, clear theoretical foundations, so economic expectations of consumers and firms crucially determine the policy transmission, but it's difficult to implement communication in a way to the general public that is controllable. First of all, there might be good intention, but the actual reach is very limited. You usually talk to a very small subset of the entire economy, and the attention economy argument that people will probably not listen to what you're saying is a very relevant one. As I said, layering and tailoring versus information flowing around matters a lot. There is, and that's what we can do sometimes, there is studies that use randomized controlled trials, going back to experimental economics, that use survey experiments to test the effects of monetary policy communication to the general public and see what we can learn from that. Whether these survey experiments, of course, can be generalized and scaled to the general public, that's another question. Let me just mention here, because that's important for us as a central bank, that financial literacy is a potentially important link between theory and practice, and that's the reason why we have a lot of initiatives that we support or that we actually pursue ourselves as a central bank to improve financial literacy in the general public, especially, of course, among younger decision makers, so adolescents and school kids. So there's very different modalities across central banks in terms of the role of governance and the outcomes. I just wanted to mention a few empirical results. So dissent, for instance, weakens the transmission of decisions to financial markets. So if people know that there was a dissent in the decision-making body, that weakens the transmission mechanism. The impact of dissent on financial markets is largest for a status quo decision. And the mechanism is perhaps that dissent is informative about future policy decisions. So people change their expectations on future policy decisions. Information on voting outcomes raises uncertainty about inflation outlook. But the effect is not driven by dissent per se, but by the revelation that there was a vote on the council. And there's a couple of papers that prove these specific results in terms of decision making and communication and expectations. I have a couple of minutes left.
Yeah, I think we have enough. Is it 15 minutes?
Perfect, that's good. I think I should manage in less than 15 minutes. The last example is on modeling wage and or discussing wage and price inflation. I talked about behavioral macro before. You could also view it differently. Behavioral macro is the logical endpoint of taking micro foundations seriously. If you take micro foundations seriously in macroeconomics, behavioral macro is clearly the logical endpoint of such a discussion. There is a quote by Woodford, not only do expectations about policy matter, but at least under certain conditions, very little else matters. And so we'll talk a bit about expectations now because they are so important. And surveys help us here, actually. So when we take a look at households, expectations are usually quite noisy and very dispersed, often not very well anchored, and move with salient prices. I think everybody knows that. Even our informed expectations as economists are influenced by the salience of certain prices, and usually the main influence is oil or gas prices and grocery prices, actually. And we have been seeing a change now since the 28th of February, the start of the Iran war, and I don't know the details of the discussion in Canada, but I can tell you in Europe there's lots of discussions on that, and governments have already reacted. They have reduced taxes on gasoline. They have temporarily, of course, they have intervened in some ways because the pressure was very strong, even if the influence on the price level is still pretty small. So we're talking about inflation rates at the moment of 2.5%, 2.6%, 2.4%, depending on the country. But not much about 2%, but still there is the perception that all the prices increased. Professionals, forecasts are tighter and closer to macro benchmark, but still show disagreement and gradual updating after news and shocks. And what always matters, and that's something that matters more now than in 2022, is the experience that you have in terms of inflation during your lifetime. There's a very nice paper by Malmondier and Nagel in 2016 where they show that these kind of experiences might actually persist over decades. And I think the policy responses in 2022 in Europe to the energy price shock was also influenced by the fact that the whole generation has not lived through times of elevated inflation levels in Europe for the last 20, 25, 30 years, the last even 40 years in the 1980s. Whereas now we are facing perhaps a situation, if it continues to matter in terms of price levels, especially for oil and gas prices, where people have this very recent experience of the shock, where people are not used to a new price level. So people very often don't think about inflation, the change of prices, they think about the price level. There is threshold prices. You don't buy a beer over a certain threshold, you rather stay at home and don't go out. And these all matter, so I'm pretty sure that the response now is different. And the reason that governments have been reacting after a couple of weeks already with some measures is indication for that increased attention to price developments. Let me just skip that in the interest of time. There is a way to do that in standard models when we don't use behavioral frictions. And the macroeconomists among you know that. I'm not a macroeconomist, I'm not the expert on that, but the idea is the Calvo theory, that some firms get picked at random to reprice, or there's the manual cost gremlin that charges a fee when firms change prices. So there is some change in these models implemented by some exogenous assumptions, actually. And then there's, of course, the data. And when you take a look at the micro price data, prices changes are typically large but incomplete, yet tiny irrational changes also occur. And prices react fast to idiosyncratic and sectoral news, but slow to aggregate shocks. So there you can look at price reactions. But is it nominal frictions or is it behavioral frictions? And I just put a few examples here of research that speak in favor of some behavioral frictions that we observe. So rational inattention, for instance, assumes information processing is costly and firms choose what to track. So that means that there is not adjustment that is immediate. If idiosyncratic conditions matter more or are more volatile, firms rationally focus on them. So prices react fast to idiosyncratic sectoral news, but slow to aggregate nominal shocks. So the attention is on the specific sector. High inflation regimes change the attention budget. So pricing can look qualitatively or quantitatively different when inflation is high or volatile. That's now the reason why we perhaps see different reactions after the new price shock than after the 2022 price shock. The attention budget is actually spent much more on prices now than in 2022. And we have some recent example from our own research, the Austrian Central Bank, where we can show that the Phillips curve becomes generally nonlinear and steep in high inflation periods, actually. Does fairness play a role? And you know the discussion that is pretty straightforward and pretty actually old already in behavioral economics. There's a very famous book, and I think I have it on the next slide if I'm not wrong here, by Bewley, where he looks at price stickiness, especially wage stickiness. And what he says is that employers avoid nominal wage cuts because that might damage the morale or the effort of the workers. So that's the Bewley mechanism, sometimes called. And there's also recent evidence in a similar vein that firms substitute away from base wage cuts towards more discretionary pay margin consistent with moral performance concerns. So you try to avoid to do the outright thing that is obvious to everybody and choose policies, I mean this is now firm policies, that are more concealed than just wage cuts if necessary. Most of these behavioral frictions suggest that a moderately positive inflation rate might be optimal to facilitate adjustments in real and relative prices and wages. So if you have a bit of inflation, and that's one of the reasons, on top of other reasons why we aim for a positive inflation rate and not for a zero inflation rate, even if you could measure inflation perfectly, you would not want to go for a zero inflation rate, is that you want to have this certain flexibility given to firms that they don't have to cut wages at some times if inflation is low and productivity growth is low or even negative, which happened, for instance, over the last couple of years in Europe. And Bewley mentions that already in the book. He calls it greasing the wheel, so inflation can grease the wheel of the economy. So central bank objectives may be misspecified given behavioral considerations. That's another aspect. So people experience inflation as a loss of purchasing power and often as unfair. We're back to the fairness argument. So prices are up and the wages lag behind. This is an argument by Robert Schiller, but there is very nice empirical evidence, a very recent one by Stephanie Stancheva in 2024 that shows that these developments might be perceived as unfair, and that's the reason why there is a demand for a reaction to it. In survey data, higher expected inflation translates only partly into expected income growth, a 20% pass-through, and that helps explain why inflation feels like a real income squeeze. Austria is a very good example here. The recent history, when you take a look at the studies that have been produced over the last couple of years, there was almost no real income loss since 2019, despite, of course, very elevated inflation levels up to almost 11% at the peak, and 3 years clearly above the 2% target. But inflation is still a very strong concern. So if you ask people what is their most pressing concern at the moment, it's not unemployment, it's not housing, it's usually price levels. And that shows you that even if you're able, or even if you pursue a policy that keeps real income stable, it might be not sufficient because people have different perceptions, actually. So this is the last slide. Transmissions may change across regimes when inflation is salient and high. Updating increase, so behavior and pass-through can look different. So I think that's important to keep in mind for these models that we have on pass-through and then on macro. There is different times, and different times might lead to different pass-through and transmission. With non-rational expectations, dynamics can be non-linear with instability and tipping risks. There is a recent paper also by some people from the ÖNB, the Austrian Central Bank, where they show that with heterogeneous long-run beliefs, inflationary shocks can generate inflation scars, making outcomes highly sensitive to the timing of policy rather than the peak reaction. So monetary policy becomes more complicated. Does this help a lot? Let me just conclude preliminary, because there's much more research I think that we need here. We know much more than I thought about behavioral aspects in monetary policy decisions, in monetary policy transmission, in communication of central banks. But sometimes it's not very helpful because it makes decision-making even more complicated. So the important thing is what to ignore and what to actually use in policy decision-making. Still, I think a coherent framework of perception decision-making is important as a foundation for macro models, as all micro models are behavioral. And if we take micro foundation seriously, I think it's unavoidable. And what is required is a reduction of complexity and variety that arises from empirical results that we get, actually. And this is not easy, but it's a huge research program that actually will occupy a lot of time. But I think that given the importance of behavioral economics for monetary policy, as I tried to convince you of, I think it's worthwhile doing. Thanks for your attention.
We actually have a lot of time for questions.
Yes, sir. Talking about where the support for central bank independence comes from, we've been seeing this in the U.S. for the last 6 months. I mean, the Trump administration tried to charge one of the governors of the Federal Reserve with mortgage fraud. They appointed a toady to the Board of Governors who always wants to cut interest rates by 50 basis points from wherever they are. They even went after Governor Powell, saying he lied to Congress and wanted to have him kicked out. And the reaction was, well, lots of former chairs of the Fed came out to support Powell and central bank independence, and people thought that was self-interest and they didn't pay any attention to it. Lots of academics came out and said central bank independence is important, but that was dismissed. They're just academics. But the people who manage money said that, you know, if you get rid of central bank independence, that would be a bad thing. And they said it's not going to happen because it would be such a bad thing. And that seemed to be what made the difference. It wasn't worrying about the voters, but it was worried about how the financial markets were going to punish the U.S. Treasury, who would try to issue debt and put somebody who was unbelievable or not credible to replace Governor Powell and really interfere with central bank independence and have the current president make the path of monetary policy. So I don't think it was individuals voting. I think it was really the financial markets that provided the discipline.
Oh yeah, that's a very good point. I think you're absolutely right. That meant a lot during the discussions in the last couple of months, since about a year now, when it all started in the US. it's perhaps not the perfect explanation for why it started in the first place, why we have central bank independence. Because I mean, perhaps this is also contributing to explanation, but there's no, the banks or the financial institutions don't go to the government and say, look, we need an independent central bank. At some stage, some people have thought of that idea. Perhaps it was just by chance that we have.
The argument was they have to make tough decisions, so you'd rather they made it than I made it as a politician.
Yeah, absolutely. I think at some stage it's in the interest of politicians. Exactly. They don't want to make these tough decisions, and if they know that they don't want to make these tough decisions, it's better to delegate it and not making it yourself. Actually, but once it's in place, you're probably right. It's stabilized also by financial markets because they see the benefits of it, and they get scared if central bank independence is jeopardized. Absolutely. Yeah.
I have a question you already said you can't answer. We can chat about it. I found your idea of a fiscal equivalent to monetary policy to be very intriguing, especially the way that you frame it. It seems quite logical that politicians, just like you said, wouldn't want to make that decision about how much spending is too much. You outsource this, you can have some reasonable economic justification for setting that threshold, and yet we don't seem to do it. Are there any countries that have pulled this off in one way or another that you know of? And what do you think accounts for the difference in treatment? Is it just idiosyncratic political happenings in the late 20th century that led to monetary policy being the one, fiscal, at least in the States, being with the Senate that seems to increase it and then threaten to shut the government down every few years?
So if I know, it's really difficult to say. I think first of all, does it exist somewhere? Not in that form, but there are countries that have implemented rules, either in the constitution or informally, some ways where political parties have agreed that there is a certain path of expenses or a certain path of deficits. Especially the Nordic countries in Europe have had this experience from very bad economic times, end of the 90s, very high deficits, almost state bankruptcies, and they implemented ways where there's norms how to do it, and they mainly stick to it, not all of them, but they stick to it. But it's not this form of an independent institution that does it. Why don't we see it? I don't know. Perhaps it's easier for the public and politicians to understand why monetary policy should be independent. They would reduce their ability to act and to discretionary policies to a large extent if they are not able to fully exploit the fiscal policy space that they think they might have actually. But yeah, it's an open question. Hopefully there will be more research on that.
Like it's related to this, but the U.S. states would have some rules about the deficit,
yeah.
Right? So that is like indirectly related, or you think that's something completely different, or?
So I mean, here it is a bit related. I mean, here it is a bit. There is of course the different layers of a federal state, and it's a bit easier, of course, to have rules by the upper level on what the levels below can do actually. Yeah? These rules exist very, very often. The European Union, we also have that no bailout rules, always observed. So these rules exist for a long time, that's true. But there's much fewer rules, at least in my reading of the empirical results, on the level of the federal level of the state. So the highest level that can decide actually. There is sometimes constitutional rules that exist. Usually there are no consequences because it's difficult, of course, to have consequences in the constitution that actually can be implemented. They can't be implemented because the government can just vote it down. So you would have to have again some supranational power or some independent institution that's really independent that implements it. Yeah. The courts sometimes can do it, but it's also difficult.
In Hungary, they tried to implement, obviously, but they tried to implement this independent budget for.
You're right. I think they had one. Yeah.
I think it still exists. But you never. Maybe it doesn't exist.
I mean, there is, so they have, I don't know the details, but they have something. I mean, of course, you know, in all European countries, that's also a European law, we have a watchdog on spending. So there is an independent research institution that provides expertise that speaks in public. So it's the idea of transparency, and that they have to exist, and they usually play a pretty important role, but they have no way of course of setting policy. They are commenting on policy, or they're analyzing policy.
So I have a question. So at the beginning, you mentioned that the fact that politicians overpromise, that suggests that people are myopic. Is that really necessary? Because, and later you talked about perception and things like that. Maybe the suboptimality of the actions they take is unclear. So I can promise, and then I can say that no, I took the right actions. It was just bad luck. Yeah.
I mean, you're right, that's true. It's more difficult to follow your argument when it comes to this political business cycles where governments spend more before elections. And you know, there's this very nice research from the 70s and the 80s of the last century where it's shown that this happens a lot, and it just increases inflation, but it doesn't increase real incomes, actually. And so that would be difficult to explain by that. And voters should know that, so they should actually punish them. They should punish the governments for that. And they usually, I mean, at least I'm not aware of any systematic evidence that they do it, actually.
So my questions might be specific. So in countries like Austria, with elevated housing valuations, so how do you balance price stability objectives against risk of housing market corrections?
So what we have, of course, there's different ways to do that. First of all, monetary policy does not take housing markets directly into account. Of course, we follow the price development and so on. We're monitoring what's happening, but in the end, there is a clear objective that's 2% inflation in the euro area, and the decision is taken by the ECB and the governing council there. So that you can't even take single countries into account. So it's always about the average inflation rate in the euro area, consisting of 21 member states. But of course, there's different instruments like financial stability instruments, buffers for banks that provide credit, and other instruments of housing policies that help to sustain a housing market that is stable. And many of these instruments have to do with bank lending, and clearly that's instruments that central banks implement, and they are actually different in different ECB member countries or Euro member countries, because the housing markets are not completely synchronized. They are even. This is probably underestimating it. The housing markets develop very differently, but these kind of macroprudential mechanisms that you have at stake, the buffers for the banks and so on, help to stabilize housing markets, and that's something that central banks can set. The national central banks can set, or certain institutions can set. In Austria, for instance, there is a financial markets stability committee that exactly is doing that, and the central bank and the financial market authority, those two, together with the Ministry of Finance, they design these policies, and that helps to stabilize it. And that makes sense. We have been discussing that a bit. Does it make sense to centralize these macroprudential policies, or does it make sense to have it on the national level? And there's a lot to be said for centralizing some aspects of monetary policy. We did that, and all the transmission and so on. But for these macroprudential policies, especially for the real estate sector, housing, but also commercial real estate, it makes sense to have national instruments, and we have them. And that helps, of course, to balance the entire system.
And compared with the housing market of Canada, so housing issues draw too much debate recently. in the last decades, too much hot money coming to Canada, plus the Bank of Canada pumped too much money into the market during COVID-19. So that's caused serious problems. We call it housing affordable crisis. So what do you have to say?
Oh, that's a good point. I think that's similar in many countries. If you take a look at the house price development in Austria, and that's true for many European countries, it was characterized by increasing prices that were above the increase in purchasing power or disposable income. So affordability declined. So this is, of course, an issue where a central bank itself cannot provide solutions alone. It's about credit, but it's also about, of course, supply of housing. It's about costs of house ownership, taxes and so on. So I think that matters as well. But yeah, the development I think was pretty similar. I don't know the exact numbers for Canada, but the development was not different qualitatively in Canada and Austria. Affordability went down. I mean, it was much more difficult to afford a house now than 15 years ago. On the other hand, we see last years, 2024, 2025, some reverse trend here. Let's see where this continues.
Thank you so much.
Thank you.
And there are still some cookies and teas and coffee outside.